Mental model for buying growth stocks on dips. This guide provides a structured approach to buying growth stocks during market corrections, aiming to capitalize on significant long-term gains, 7 to 20 times, over a 2 to 3 year holding period, with an optional leveraged strategy using leaps for higher potential returns. 1. Identify high-quality growth stocks criteria for selection. Strong fundamentals. Focus on companies with high revenue growth, 20% plus year over year, innovative products, services, and expanding market share. Growers typically dominate their markets with high market share. Competitive advantage. Look for businesses with unique technology, brand loyalty, or network effects, e.g., proprietary AI-dominant platforms. Scalable business model. Prioritize companies with clear paths to profitability or improving margins. Focus on low capital requirements and non-capital intensive businesses, e.g., software, platforms, or asset-light models. Screening tools. Use financial platforms to filter for high-growth metrics, e.g., revenue growth, EPS growth, high market share, and low capital intensity. Examples: tech, biotech, or renewable energy companies with disruptive potential and lean operational models. 2. Confirm a market dip. Define a dip, a correction of 20 to 50% from recent highs, typically lasting 6 to 12 months, often driven by macroeconomic factors, e.g., interest rate hikes, market sentiment. Technical indicators, relative strength index, RSI. Look for RSI less than 30, indicating oversold conditions. Moving averages. Confirm stock prices below 50-day, 200-day, and 200-week moving averages, signaling a significant discount. Volume analysis. Higher selling volume may signal capitulation, a potential bottom. Valuation metrics. Stocks often trade at or below 2 times price to sales, PS, or near tangible book value during dips. Compare to peak valuations. Growth stocks may trade at 10 times price to sales or 30-plus price to earnings in bullish markets. Market context. Ensure the dip is not due to company-specific issues, e.g., poor earnings, legal troubles. S&P 500 is often low during these periods, reflecting broader market weakness. VIX is typically high, e.g., above 30, indicating market fear. News sentiment is predominantly negative, amplifying pessimism. 3. Evaluate entry points. Timing the dip. Avoid catching a falling knife. Wait for signs of stabilization, e.g., price consolidation, reduced volatility. Use dollar-cost averaging, DCA, to spread purchases over weeks, months to mitigate risk. Valuation. Check. Confirm price-to-sales ratio less than or equal to 2x or price near tangible book value relative to historical averages or peak valuations, 10x price-to-sales, 30-plus price-to-earnings. Ensure the stock is undervalued relative to its growth potential and market share. Risk management. Allocate no more than 5 to 10% of your portfolio per stock to diversify risk. Commit to a 2 to 3 year holding period mindset. Be prepared for volatility. Growth stocks may remain flat or dip further before recovery. Catalyst tracking. Monitor company milestones, e.g., product launches, earnings beats. Watch for macroeconomic tailwinds, e.g., falling interest rates, sector momentum. Patience. Historical patterns suggest 7 to 20 times gains materialize over 2 to 3 years, followed by slower growth. Optional. Leverage with 2-year leaps. Strategy. For investors seeking higher returns with increased risk, purchase 2-year leaps, call options, that are at the money, ATM, or slightly out of the money, OTM. Leverage potential. Leaps provide 4 to 5 times leverage, potentially turning 7 to 20 times stock gains into 28 to 80 times returns on the options. Selection. Choose leaps with 2-year expirations to align with the 2 to 3 year holding period. Select strike prices at or slightly above the current stock price, e.g., 5 to 10% out of the money, to balance cost and upside. Cost management. Allocate a smaller portion of capital, e.g., 1 to 2% of portfolio per position due to high risk. Risk. Warning. Options carry 100% downside risk, total loss of premium, if the stock fails to recover above the strike price by expiration. Monitoring. Track the same catalysts as the stock strategy. Be prepared to roll options forward if needed to extend time horizon. Sixth, monitor and reassess regular check-ins. Review quarterly earnings for sustained growth metrics and market share dominance. Assess if the company's competitive edge and low capital intensity remain intact. Exit strategy. After 3 years or during favorable market conditions, e.g., high valuations, 10x PS or 30 plus PE, consider selling a portion, e.g., 1/3, of stock or options to recover seed capital and fund new investments. Retain the remaining position to benefit from continued growth, as high-quality growth stocks typically grow at 20 to 30% per year on average post-recovery. Alternatively, sell the full position if fundamentals deteriorate, e.g., declining revenue growth management issues. 7. Risk considerations. Market risk. Broader market downturns, low S&P 500, high VIX, can delay recovery. Company risk. Growth stocks are volatile. Some may fail to recover. Options. Risk. Leaps carry 100% downside risk with potential for total loss if the stock underperforms. Liquidity. Ensure sufficient cash reserves to avoid forced selling during prolonged dips. Psychological discipline. Avoid panic selling during negative news cycles or FOMO during rapid recoveries. Example, workflow screen for a growth stock with 30% plus year-over-year revenue growth, high market share, low capital intensity, and trading 30% below its 52-week high. Confirm oversold conditions, RSI less than 30, price below 200-week moving average, PS less than or equal to 2x, and negative market sentiment, low S&P 500, high VIX. Invest $10,000 via DCA over 2 to 3 months in the stock, or allocate $2,000 to 2-year ATM/OTM leaps for 4 to 5 times leverage. Hold for 2 to 3 years, monitoring earnings and catalysts. After 3 years or in bullish conditions, sell 1/3 of stock options to recover capital. Hold the rest for 20 to 30% annual growth, or reassess if fundamentals weaken. Key takeaway. Buying growth stocks on dips requires discipline, patience, and a focus on high-quality, high market share, low capital-intensive companies. By targeting stocks trading at or below 2 times price to sales or near tangible book value during broad market weakness, low S&P 500, high VIX, negative news, investors can aim for 7 to 20 times returns over 2 to 3 years. Using 2-year leaps can amplify returns to 28 to 80 times with 4 to 5 times leverage but introduces 100% downside risk. Selling a portion during favorable conditions allows capital recovery while retaining exposure to 20 to 30% annual growth, balancing risk and reward.